Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Thanks for listening to the show. April 9th, 2026. Well, that 2-week peace plan didn't go exactly as we wanted. But are we in a better place today than yesterday on the price of oil? Yes. But oil is rising back above $100 a barrel after a big drop as the Strait of Hormuz stays blocked. We saw today that the Fed's preferred inflation print stayed hot in February. The PCE inflation rose 2.8% before the outbreak of the war, suggesting the Fed will keep interest rates steady. Still, in the last meeting, the Fed released their minutes yesterday. They're still expecting rate cuts this year. Oil prices are surging as the U.S.-Iran ceasefire looks increasingly tenuous. I'll be honest, from what I'm hearing out of media sources, and those aren't real people in Iran, but conditions are pretty miserable with water and food. This will end soon. Generation Z is driving IRA contributions to record highs. I saw that this morning. I was like, super happy. Good for Generation Z. According to Fidelity data so far this year, Generation Z has accounted for 34% of total contributions to IRA accounts. That's more than any other generation so far. Millennials had the second highest participation at 20%. Those aren't great numbers, but saving for retirement is not just something I believe in. I think it's, if you don't do it, you're going to get what you settle for, and retirement's not going to be nice. Let's take a look at the market numbers. Markets started off in the red, but have turned green on the S&P 500 and the NASDAQ, but only up 0.25%. The Dow Jones Industrial Average is up 0.1%. All three of those indices were in the red to start the morning, kind of sunk there, and things started to slowly turn. Russell 2000 is down fractions. The VIX Volatility Index sits at 20. Gold sits up 70 basis points to 48.10. Bitcoin sits up $547 to 71,710. The CBOE 10-year Treasury note sits at 4.29%. Not doing a lot, just sticking there. I saw this and this made me laugh. Property taxes increased by nearly 25% in recent years. California has the Prop 13, which is just damaging to homeowner turnover. And I hate it. I benefit from it and I hate it. U.S. homeowners paid about $633 more on average in property taxes in 2024 compared to 2019. It's part of the cost of owning a home. Renting's not the worst thing in the world. I hope people learn that over time. It gives you a lot more flexibility and allows your big chunk of change in California that's likely paid off if you're on Prop 13 from 1970s to put that money to work in the markets or in money market accounts. So you're trying to beat inflation with the value of that home. Sorry, my voice is a little froggy. I got hit with allergies this week, and boy, did I feel bad. And now I just have this lovely, sexy voice, froggy voice. We'll all live, we'll all live. Don't worry about that. Got a lot of technology to talk to you about today. So a lot of Fed officials said yesterday when we went through the notes from the Federal Reserve meeting that the next move will be a rate cut. I think that's great. Amazon's in the news a lot today. Let's talk a little bit about it. Citron Research is talking about the difference between Amazon and Walmart. They talk about how ridiculous the discount of Walmart multiple should close. For 4 years, the market rewarded Walmart for stability and punished Amazon for capital expenditures. Walmart looked like the adult in the room. Today, Andy Jassy just showed you what the CapEx built. The most serious threat to NVIDIA's semiconductor dominance ever created. Amazon. $50 billion standalone revenue on run rate. Triple-digit growth. Trainium 4 not even shipping and already sold out. 2 customers tried to buy all of the Graviton capacity for 2026. Amazon said no. This is another $1 trillion company hidden inside of Amazon. This does not exist in a single sell-side model, not one. The market spent 4 years punishing Amazon for building this. Now it's built, and Walmart still trades at 45 times earnings for 4% revenue growth, while Amazon sits at 26 times forward. Walmart sells potato chips. I was like, when I saw that, I was like, potato chips? Yeah, like it's food. At 45 times earnings, Amazon sells AI chips at 26 times forward earnings. And they also sell a lot of potato chips, Amazon does. So I get the play on words that semiconductors, chips, and Doritos are chips. He thinks the multiple has to flip at Citron Research. This is the time of year where Amazon gives us an update on what's happening at the company through a CEO letter. And Amazon's cloud unit AI revenue run rate exceeds $15 billion. Stock's moving higher today. The AI revenue run rate topped $15 billion in the first quarter of 2026. The first hard number the company's provided for its top-line AI performance. Sales generated from the emergent technology are ascending rapidly and already at 260 times what Amazon Web Services revenue were at a similar time in its maturity. So the market's focusing on oil. I'm focusing on tech today. I think we got that big disconnect in tech valuations that has happened since essentially October of 2025, giving you a buying opportunity on some of these names. And I agree with Citron Research. Amazon should have a higher valuation. Now, again, for consistency, Walmart. Meta Platforms and CoreWeave announced an expanded long-term agreement for AI computing capacity worth $21 billion. Meta needs all the compute it can get for things like Reels and its new AI models, and CoreWeave has the chips, including NVIDIA's forthcoming Vera Rubin. JP Morgan upgraded Capital One to buy from hold, naming the credit card issuer its top pick in the consumer financial sector. JP Morgan sees limited downside from here unless new tail risks emerge. Let's talk a little bit more about that. I do love a little good research. So overweight from neutral. They're re-rating the stock since the start of the year. Year to date, the stock's down 20%. While sector valuations have pulled back amidst macro uncertainty, they see limited downside from current levels unless new tail risks emerge. Since the Discover Financial Services merger, they have viewed Capital One as thematically intriguing, but we're waiting for a more attractive entry point from a valuation perspective. They believe now is a good time to get on board, with the focus now shifting to integration and synergy realization. And with the stock trading at a discount to historical levels, they see a favorable risk-to-reward setup for investors. Let's talk about that. When I got deep into that, what I saw was it's having a bad year, and it makes for an attractive entry point. I have no problems with that. That's the way I like to buy stocks. Now, with a Capital One, I'm probably thinking a little bit of growth, a little bit of income. They're not going to come out with Capital One Credit Card 2.0. They are going to get in trouble when economy's slow. And they're going to have write-offs, but that's accounted for in the math many times. So yesterday we had this big relief rally. The S&P 500's climbed 6.9% from the war-driven bottom on March 30th. It's just 3% below its record close. You own stocks, you stay calm, you look for discounts that may be attractive entry points. You don't panic. Texas Instruments got an upgrade from Stifel to buy from hold after a 6-year investment cycle that weighed on profits. This is interesting because it's got a big, fat dividend. Stock's done nothing for years. Let's talk a little bit about Texas Instruments in the analyst words. Following an elevated 6-year investment cycle that constrained profitability and returns, they believe Texas Instruments is well positioned to capture share in the next analog upcycle and return to strong free cash flow generation. They're entering a period where multiple tailwinds support the outlook. As such, they're upgrading Texas Instruments to buy with a 12-month price target of $250. Should the company execute towards their bull case, the target price could reach $286. The $250 price target represents 26 times free cash flow, which could be conservative. So I just mentioned that it's got a dividend. This show has really turned into a 30-year journey from when I was a young man to a man who's approaching retirement sooner than later. Could be 1 year, it could be 10 years. Depends on what you say retirement looks like. I'm done working 80-hour weeks. Just listen to my voice. It's another voice. To me, it's pollen. But Texas Instruments has a 2.72% dividend yield. I would never own Texas Instruments for stock appreciation. Even though it's a $214 stock, and I think we just said that the analyst sees potential to 286 in a best case scenario, 250 in a normalized scenario. 20% returns are 20% returns, plus that dividend. Ooh-wee. You know I like that. Marvell Technologies landed an upgrade at Barclays. Analyst took the stock to buy from hold and said Marvell is the first and foremost an optical company. You've seen how Corning, Lumentum, and others have done with optics, and how we're going to try to, not how we're going to try to, how AI is building AI data centers, both with copper and optics. Marvell's business of co-design custom AI chips is usually what gets the most attention. Right now, the optical sector is red hot, and people are starting to look there. Dell's in the news today. Again, another stock that I want to look at the chart and tell you what I see. But Wolf Research started coverage of Dell with a hold and no price target. Analysts warned about memory prices putting pressure on margins. That kept a lot of people out of Dell before. Yet the AI server build still turned in a really great quarter. With Dell, Wolf Research calls it a peer perform. That's not bad, considering the AI trade's gone sideways since October of 2025. Potential memory issues include margin pressure, demand destruction, and order pull forward and lack of supply. Crazy environment, so says Wolf Research. Wait for a better entry point. They're torn on Dell shares. The business trades at 11 times 2027 earnings per share. For a company that's growing in the mid-teens, investors are getting an AI play. 27% of their sales come from AI servers. That could expand to 40% over time. The recent issues at Supermicro have the potential to boost Dell's AI server business with already significant customers such as CoreWeave and xAI. Given their market position in the large enterprises, Dell also sits in a great position as enterprise eventually deploy AI servers on premise and at better margins for Dell. Separately, their traditional server business can benefit from the market shift towards inferencing, especially for CPU-based compute and agentic AI applications. It's an attractive setup. Now, having read that, my first thought, wasn't this a negative report? And everything that I just read sounds basically positive, except for the margin pressure on memory. Stock's trading down 2.8% today to $180 a share. It's got a dividend yield of 1.3%, which I think is noteworthy. I probably won't be buying a computer in the next year or 2 years because I bought one last year before memory prices moved up. But if I had to, I would. I do a lot of work on a computer. I'm going to spend that extra money. For me, it's going to be probably a Dell that I buy. They make really solid machines. When you're looking at their PE for 2026, it trades between 9 and 13. That's below market. In a stock market that's worried about valuations, I find that attractive. Again, am I telling you what to do? No. Always consult a broker advisor for taking action on any stocks ever mentioned on this show. Just giving you ideas. Now, again, would I buy it for my kids? No, but would I consider it for me? Probably Texas Instruments, I'd consider it for me. With Dell, I like the valuation. I wouldn't poo-poo it. I do need to do some more research. We talk about this and more at the Pints and Portfolios Saturday, April 18th, 11:30 to 1:30 in Sunnyvale, California. It's a brewery. It's over half full. So your opportunity to sign in now. For investors with more than 500,000, 50 years old plus, you're heading towards retirement. This is an ideal event for you because you get asked questions of financial planners. I bring 2 with me. And if we get enough people signed up, I bring 3 with me. I talk about my side of the business, which is research. They talk to you about your portfolio, about your kids, about your family, about how much you've saved, about what you want retirement to look like, about do you have a home? Are you going to do inheritance? What's your plan? Super informal. These are some of the nicest people I've ever met. Ryan, Julie, and Dan. And Julie's going to be my financial planner when Brad retires, probably in the next 2 years. That just tells you how much I really like sharing these people with you. Sign up for the event at robblackshow.com. It's Sunnyvale, California, Saturday, April 18th, 11:30 to 1:30. I'm Rob Black.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
As is often the case, when we wait an hour and a half in between segments, the markets tend to go a different direction. So I like to check back in a second time. And today, that's exactly what's happening. Markets opened a little bit in the red, i.e. profit taking and or concerns that oil was above 100 again, that the 2-week ceasefire wasn't going to stick. Of note, Vice President Vance is going to be in the Middle East this weekend to talk peace. We'll see what comes out of that. But the S&P 500 is now up 0.6%. It's moving. Dow Jones Industrial Average just 0.5%. The Nasdaq's up 0.75%. We're having a very good day. Russell 2000 up 60 basis points. The markets are within 2.5%, maybe even less, of their all-time highs on the S&P 500. Now, if I were to tell you that a month ago with this whole war thing, you'd be like, no way. And all I'll say is way. The Dow just secured one of its best trading days since Liberation Day. Each of the major stock averages gained 2% yesterday. The lower oil helps our economy in big ways. Lower fuel costs for airlines, lower inflation pressure for consumers, a more accommodative backdrop for the Federal Reserve, who in their note said the next direction is probably lower on interest rates, which should give gasoline to the stock market as far as future returns go. But as we know, shortly after the truce was announced, yesterday we saw bombs flying in Iran, basically keeping the Strait of Hormuz shut. So it didn't hold. Year to date, Brent crude's up 59%, silver's up 4.8%, gold's down, gold's up 9.7%, Bitcoin's down 20%, Russell 2000's up 4.4%, and the S&P 500 and the Dow down less than 1% for the year. Let's talk about some research. Spotify is viewed as a key audio platform by citizens. I agree with this. I think there are some problems going on with Spotify, including Universal Music. They own a share of it, and it looks like it's going to be sold out from underneath them. But citizens research calls it a market outperform $800 stock. It's a $500 stock today. That's an amazing call. You don't see that often in your lifetime. But let's see what he had to say. Spotify possesses immense structural advantages across its multi-vertical platform, spanning music, podcast, video podcast, and audiobooks. It's got 750 million monthly active users and a vast proprietary listening data set that enables increasingly differentiated, personalized experiences. This scale and breadth establish Spotify as a primary destination for discovery and monetization across the audio ecosystem, while positioning it as a net beneficiary of AI. Through years of product innovation, deep personalization, and ubiquitous distribution, Spotify has built a best-in-class multi-format audio experience that supports compounding growth and engagement revenue and free cash flow. At 18.5 times 2027 earnings before interest, tax, depreciation, and amortization, the risk reward is compelling, according to citizens. Again, they have an $800 price target. I'd consider adding more to the position at this point in time, if you own it, and potentially trading out of it over time. If you're worried that YouTube Music is going to be a dominant platform. And there's a real possibility that happens. Apple's not as worrisome, but Apple's got 2.5 billion devices out there. And when they sell services, if you want to get the storage plus the music plus the TV plus the other services that they have, they can bundle them. And that's where Spotify is weak. SanDisk is jumping today as Bernstein raises the price target to a Wall Street high of $1,250. Bernstein boosted its earnings estimates for the company. Stock's up 5.8% today. They went from a $1,000 price target to $1,250. They're the most optimistic of the 23 analysts polled by Bloomberg. Memory prices continue to surprise to the upside, with Flash showing the strongest increases and continued acceleration. I'm not a big fan of Seagate or Western Digital. I find what they do is not very difficult. It's storage on disk drives, which we've had that technology now for, holy mackerel, a long time. And its evolving nature is slower than, say, that of the memory companies that are tied towards Flash. Flash memories increased in speed pretty much so consistently every few years. Bernstein analysts even threw a blue sky scenario in on SanDisk to get to 3,000, should an even more bullish scene play out for both earnings and market valuations. Already up nearly 250% this year, SanDisk has been the best performing stock in the S&P 500. They report earnings April 30th. Intel is collaborating with Google Cloud for AI. Who knew old boring Intel would be as sexy as they are this month? The deal includes co-development of custom chips for Google's needs, a program that Intel says is reinforcing the critical role of CPUs and custom infrastructure processing units in scaling modern heterogeneous AI systems. I think I talked about this earlier. Capital One being upgraded by JP Morgan to overweight from neutral, following a significant re-rating. Yeah, that's right. The stock was down 20.6% for the year. In try to make me laugh out loud, OpenAI, Anthropic yesterday warned that it had developed a new model that was too dangerous to cybersecurity to be released to the public. OpenAI is saying the same exact thing today. It's like, see, us too. OpenAI is saying new cybersecurity tool is working on, separate from its rumored forthcoming SPUD model. Axios wrote that OpenAI is allowing a small group of partners to test its new AI tool, which has advanced cybersecurity capabilities. So you're seeing names like Cloudflare, Zscaler, CrowdStrike, Palo Alto Networks, all down sharply today. They're in the business of protecting enterprises. And OpenAI says, we kind of got that capability too. Whereas Anthropic is like, we're not going to release it. We're going to give it to companies like Cloudflare and CrowdStrike, Palo Alto Networks, NVIDIA to help them develop technologies so that enterprises can't be hacked. More on OpenAI, their Stargate shrinking again. I don't know if you remember back at the White House last year, there was this big, hoo-ha-ha-ha with President Trump at the start of his second term. The OpenAI partnership with Oracle and SoftBank sought to build massive data centers around the world, including sites in the UAE, the UK, and Norway. Today, we're learning that OpenAI is pausing the Stargate UK project, citing high energy costs and regulatory obstacles. Last month, the company and its partner Oracle scrapped its planned expansion of Stargate 1 data center in Abilene, Texas. So the press releases are starting to be trimmed down. The scope is starting to be trimmed down. Keep that in mind. It is a matter of time before a lot of air is let out, or maybe it's done slowly. And then suddenly you're like, holy mackerel, I can no longer float on this balloon. Southwest is doing something that is a little shocking. They're raising fees on their bags that they started for the first time last year, less than a year ago. So they're jumping from $35 to $45. The second bag goes from $45 to $55. They quietly disclosed the change. Southwest assigned the decision to part of an ongoing analysis of business and, again, the evolving global backdrop. Jet fuel prices have dropped to $4.16, down from $4.81. President Trump's ceasefire announcement has been the catalyst for that. I ask a question of you. Do you think JetBlue, United Airlines, Delta Airlines, and Southwest as well as American Airlines are going to roll back their baggage fees when jet fuel prices get back to where they were, if they get back to where they were. Some people think there's going to be a new normal on the price of oil, maybe set in the $80 level instead of the $65 level. So American Airlines also upped their bag fees today. For tickets booked on or after April 9th, the new bag fee for domestic flights, including Alaska, Hawaii, Puerto Rico, and the U.S. Virgin Islands, Canada, short-haul international flights is $50 for the bag, $60 for a second bag, $200 for a third bag. Ouch. Yesterday, I saw a tweet, and it kind of pissed me off because it's the kind of thing that is so wrong that someone needs to call it out. One analyst said this was the 25th time in history that the stock market, the Dow Jones Industrial Average, rallied 1,000 points on an intraday basis. Now, what's wrong with that is that the Dow's at 50,000. On a percentage basis, it was good. I'm not going to say that, not. But 23 out of the 25 times that the market has rallied 1,000 points, it's been under Trump, 2 times under Biden. These are big, round numbers. 50,000 is much easier to go to 51,000. What's that, a 2% move roughly? Whereas 10,000 to 11,000 is a 10% move. So I don't like how that's manipulative. I get it, but I don't like it. Let's take a look at some of the other stories out there today, see what we can see. Meta's new AI can't compete with Anthropic's Mythos. It's not a problem for the stock. A new era of artificial intelligence models means the inevitable race to compare and contrast just how good they are. Who's going to be the best? Again, I think Alphabet / Google / Gemini is great for consumers. OpenAI, I haven't figured them out yet. Anthropic is great for enterprises. Meta, if they can tie it into Instagram and Facebook and social media, maybe they're a social media leader. I don't use a lot of social media, so I don't have a vibe. But models are increasingly specializing in different areas, create an environment where multiple models can work. Whereas Anthropic is focused more on the enterprise, Meta is leaning into practical AI applications in areas like shopping and health. Disney announced a major shakeup to affect up to 1,000 workers, planning to cut as many as 1,000 employees over the next few weeks. It'll be the first job cut since the Disney company appointed Josh D'Amaro as its new CEO. Disney is the latest major entertainment company looking to reduce jobs amid economic uncertainty due to the war in Iran, rising oil prices, and geopolitical instability. You would think that Disney would be wanting to produce more content to give us a break from the reality of war. Many of the reported layoffs to come at Disney will be in the company's marketing department. Disney employed around 231,000 people as the end of fiscal 2025, which saw an annual revenue of $94.4 billion. About 76% of Disney's global workforce is full-time, while around 172,000 of them work in the United States. These are pretty wild numbers. And finally, Andy Jassy is so bullish on Amazon's chips that he actually took a shot at NVIDIA. That's weird. Partners at times, enemies at others. Jassy said Amazon's chip business is on fire and that this demand is part of a shift in which companies are diversifying where they buy their AI chips from. Listen to this. Virtually all AI thus far has been done on NVIDIA chips, but a new shift has started. We have a strong partnership with NVIDIA. We will always have customers who choose to run NVIDIA, and we will continue to make Amazon Web Services the best place to run NVIDIA. Jassy said that customers, however, want better price performance. He compared the shift to Amazon eating into Intel's dominance in the CPU space with its own chip that it launched in 2018 called Gravitron. Same stories unfolding in AI. Amazon's the stock to watch right now. Still my stock of the year. One of them. The Pints and Portfolio you can still sign up for. It's coming up Sunnyvale, California, Saturday, April 18th, 11:30 to 1:30. You want to talk financial planning, what you're doing right, what you're doing wrong, I'll buy the beers. It's limited to 10 people. Sign up at robblackshow.com. It's robblackshow.com. That's April 18th, a couple Saturdays from now.
You are listening to the Rob Black Show podcast. For more information on EP Wealth, visit robblack.com. That's robblack.com.
I work with a lot of financial advisors. I call them CFPs. They like to be called wealth advisors or financial advisors. CFP is a certified financial planner designation. I think it's the most important designation in your financial future. They spend hours planning for their clients' investment growth, maximizing returns, minimizing cost, fine-tuning portfolios for every market twist and turn. The biggest threats to financial success aren't always in the investment account, and this is where a financial planner comes in quite wisely. I have a financial planner for my family, and we talk to Brad probably 4 to 6 times a year, and it's always enlightening. I've asked some advisors for some feedback on financial advice for long-term success, for retail investors. One of them said more and more wealth is moving to people who have not been the primary wealth management client of the past. They're seeing a massive structural change where wealth is moving more and more to women through inheritance, divorce, longevity, and entrepreneurship. When my father died, he had done finances every year. My dad was a bit of a jerk. During tax season, he would make her sign the tax documents without seeing the paperwork, which is very odd. Historically, the wealth management industry has been built primarily with male decision makers. There's too many men in this industry. The overlooked risk is that the person who ultimately will control the wealth hasn't been deeply engaged in the plan. And that's exactly what happened to my mom for the next 25 years. I had to end up taking over as her financial planner in absentia because she couldn't do it herself and she didn't know what a financial planner was. So when there's a divorce, that's another thing that's just wild at how it hits women. You might look at it as a legal event when in reality, it's one of the most complex financial restructuring events that a family will ever go through. When I got into this industry 30 years ago now, 30 years, 1996, when I was doing radio and financial media, I would say things like, I wrote a book, Susie Orman's Like the Devil and 88 Other Things You Need to Know. And the publisher was like, it was originally called Susie Orman is the Devil. And that was just one small chapter where I was like, when you watch people on TV, they're not your friends. They don't know you. They don't know your portfolio. She used to have 1% of her money invested. What a shame. And she was proud of it. Some of the things that I used to say that she used to wear her pants on her as a jacket. Like she just wore these outrageous outfits. And she did things like how to financially fix your credit. And she sold it as a kit for $90 when you could get it for free on the internet because the internet was around 30 years ago. But one of the things in another chapter in my book, other than the Susie Orman chapter, was ladies in the divorce, don't take the house, take the 401k. Because it's much tougher to save money for retirement than it is to find a place to live if you have money. And a lot of people are like, oh, it's where my children grew up. And that's my horrible impression of a weak, financially minded woman that is so out to date, I should be ashamed of myself. And I am. So divorce is a significant financial restructuring. Without planning, there's a lot of risk where families can lose significant amounts of wealth. If women in particular have not been involved in the decision making, they have no context. So every time I do something big, like buy a dip, like let my insurance run out, like, and again, that's life insurance because now that I have wealth, as I approach 60, I don't need it. I needed money to cover me and my obligations at age 30 to 60, at age 40 to 60, at age 50 to 60. And guess what? I've done well enough that I don't need it. If I die, she will go on. My children will go on. I know. You're like, are you trying to do the Titanic scene? My heart can't go. Yes, you will go on. So jumping in late in life into financial decisions is brutal. I know a young woman who last year, she's probably about 40, and both of her parents died within weeks of each other. And she just wasn't ready for it. And she didn't do anything. And she just let the firm, which was a pretty average bank, do the financial wealth. And she had wealth. She blew it, in my opinion. Another area that financial advisors will tell you that there's a big risk is longevity. We all plan for retirement, but the unknown is who depends on us. And like my children, I can be honest and tell you that I don't know if my children will ever make 5% of what I've made in my life. I don't think they will. I think their lifestyle will be stunted if I gave them nothing. So longevity and dependency can change your whole financial plan. And it's not something you think about. It's not the Strait of Hormuz. It's not Saddam Hussein. It's not Iran. It's not inflation. I see a lot of people who are parents who are aging and needing care and additional support, often at the same time that their adult children are financially dependent or not fully launched. That's a tough situation. The vast majority of retirees will need long-term care at some point. I always used to joke on my show, like once I turn 50, I'm going to marry a younger woman who's 20. And when she turns 25, I'm going to marry another woman who's 20 because she'll have the heart and the vigor to take care of me. And it was just a joke in poor taste. But the negative assumption is that I want someone to take care of me. My mom took care of my dad. Who's taking care of my mom? She did it on her own until she couldn't. Then we put her in an old folks home. And that was sad. We did it on the fringe as best we could. Everyone wants to assume everything's going to be okay. If you build in a hard situation or two, an outsized expense or three, it'll have meaningful impact on your financial plan. It's the team of people that you work with that can help you spot some of these. Like I saw the level of fraud on elderly with Bitcoin, with digital currencies. It's in the 9 digits. It's shameful. We got to watch out for our parents. We got to watch out for our elders. Respect your elders. I don't want to be that guy, but I'm not kind of that guy. Pints and Portfolios, Saturday, April 18th, coming up, 11:30 to 1:30. We'll talk about this and much, much more. Sunnyvale, California. It's informal. It offers you a second opinion analysis of where you are, what you've done right on the road to retirement, and maybe some areas that you're missing. And it's social. I bring 2 CFPs with me, which we just talked about. And you can sign up for the event at robblackshow.com. That's robblackshow.com. That is Sunnyvale, California, April 18th, 11:30 to 1:30.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.